Hi everyone, welcome back. In this session, we're going to discuss one of the most sought after topics that was introduced by IFRS 9, which is the expected credit loss approach. Previously, prior to the introduction of IFRS 9 or Ind AS 109, we used to basically create provision for bad and doubtful debts. Whenever we believed that we wouldn't get any money from our debtor, then we would basically create a provision for bad and doubtful debts, or also known as allowance for bad and doubtful debts. All right. And what we basically used to do was we used to debit that provision in our P&L account, and the credit was basically shown as a reduction from asset. We used to show the gross receivables less any provision for bad and doubtful debts, and we then had the net receivable. Expected credit loss approach is an extension of the same concept, but the only major change that they've actually done is that the previous provision for bad and doubtful debts that we actually had was based on an incurred loss approach, whereas over here it's based on expected loss approach. Now, what's the difference between incurred loss and expected loss? Under the incurred loss approach, basically we used to wait for the debtor to become unlikely to pay us money. All right. Let's say I've sold the goods to you today. I will create a debtor, but I will not create any provision for bad debts today. Because I am expecting the money to be received from you. I've sold you the goods only today. I'm expecting the money to be received from you. Therefore, I do not create any provision for bad and doubtful debts on day one. I will wait for days to pass by. I will keep monitoring your credit worthiness. I will keep monitoring your ability to pay my debt. Whenever I believe that you are unlikely to pay me the amount, whenever I believe that I'm doubtful to receive the amount, at that point in time, I used to recognize a provision for bad and doubtful debts. So if you actually carefully look at it, I was waiting for the debt to become unlikely to pay. I've sold goods to you today, but probably maybe I was waiting for the next 6 months, and only after 6 months, when the debt became unlikely to be paid, that was the point when I actually made a provision for bad and doubtful debts. That is called as the incurred loss approach, because I almost waited for the loss to be incurred, and only then I recognized the provision in my books of accounts. After the global financial crisis, they all concluded that the incurred loss approach was a little too late, which means that we were recognizing a provision much after the debt actually turned out to be bad, and we were actually kind of showing a very rosy picture right on day one. And all of a sudden, when huge amounts of debt actually became bad, we kind of actually had major losses in our P&L account. Therefore, we moved from the incurred loss approach to the expected credit loss approach, where right on day one, whenever I am actually recognizing a loan or a debtor, all right, the expected credit loss is not typically changing the way manufacturing entities or service sector entities recognize provisions, but it is a major change more from a bank's point of view. Therefore, instead of saying the word debtor, I will actually rather use the word loan. So whenever I'm giving you a loan, right on day one, I will recognize an expected credit loss, also known as provision for bad and doubtful debts. All right, but the provision for bad and doubtful debts terminology is not used anymore. It's only expected credit loss. So right on day one, whenever I as a bank am giving you a loan, right on day one, I will recognize an expected credit loss. I know that if I've given you a loan, it obviously means that most likely I'm expecting to receive the money from you. However, I will still recognize a very, very small expected credit loss. We'll see how the amount is calculated as we move ahead. Now, firstly, before that, what do we mean by credit loss? All right, the words expected credit loss has got the term as credit loss. What do we mean by the term credit loss? Credit loss is nothing but the loss that I as an entity am expected to incur on account of counterparty credit risk, on account of the credit risk. I as an entity have given you a loan or have sold goods to you. All right, I have an asset, I have a receivable from you. That receivable could be of any sort. All right, the loss that I'm expected to incur on account of credit risk, all right, the loss that I'm expected to incur on account of credit risk meaning the failure by the counterparty to pay me the amount. All right, when you fail to pay me the amount, what is the loss that I'm expected to incur? That is called as the credit loss or the credit risk. All right, now it's primarily applicable to debt contracts, whether be it investment in debentures, it could be a loan that is given by me to you, or it could be a trade receivable, or it could also be a lease receivable under financial leases. Remember, under financial leases, we recognize a lease receivable right on day one. If I am giving you an asset on lease, and if that asset is classified as a finance lease, I recognize on day one finance lease receivable, and this ECL concept is applicable to finance lease receivable as well. All right, so it's primarily applicable to debt contracts which are not measured at FVPL. All right, so two conditions: one, it's supposed to be a debt contract. Second condition, it is not supposed to be measured at fair value through P&L. Now, when I'm saying that it is not supposed to be measured at fair value through P&L, I'm obviously implying that it is applicable to amortized cost and FVOCI exposures. All right, so it is applicable to amortized cost and FVOCI. So just repeating, it is primarily applicable to debt contracts which are not measured at FVPL, which means it is applicable to those exposures which are measured at amortized cost and FVOCI. It is not only applicable to on-balance sheet exposures, which means it is not only applicable to exposures that we see on the balance sheet, but it is also applicable to off-balance sheet exposures. Now, what do we mean by the term off-balance sheet exposures? Example, let us say I have given a guarantee, all right? Let us say my friend has actually taken a loan from you. My friend has actually taken a loan from you. I have given you a guarantee saying that if my friend does not pay you the money, I will pay you the money. I'm repeating myself. My friend has taken a loan from you. I have given a guarantee on behalf of my friend saying that if he does not pay you the money, if he does not repay you the loan, I will actually pay you that loan. So it is basically a financial guarantee for me. I have given a financial guarantee. It is a contingent liability for me. All right. The financial guarantees are off balance sheet commitments and contingent liabilities. It is a contingent liability for me, and I am expected to recognize ECL on such financial guarantees as well. Similarly, let us say you and I have entered into an agreement whereby I am saying that I am committing a loan to you. You can come at any point in time in the next 1 year and you can take a loan of $10 million from me. All right, you and I have entered into a commitment today saying that in the next 1 year, you can come and take a loan from me at $10 million. That is called as a loan commitment given. All right, I am a bank and I've given you a loan commitment. That is called as a loan commitment. And even on such exposures, we are required to recognize ECL. Look, if you actually think of it, in the context, in the example of a loan commitment, I have not given you any money. I've not disbursed the loan as on date. Still, even though I have not disbursed the loan as on date, the date on which we are signing the commitment, this date on which we are signing the commitment agreement, I will still recognize an ECL on my in my books of accounts. Just repeating, in the context of debt contracts, you have actually given out a loan, you actually have a receivable on balance sheet, and we are recognizing a provision against that receivable. In case of off balance sheet, what I'm trying to emphasize is I have not even given you the loan. We have only entered into a contract where I'm saying that you can come and take a loan anytime in the next 1 year. Even on such contracts, without the loan getting disbursed, right on day one, I will be recognizing ECL. How are we going to calculate ECL and why are we recognizing ECL? We'll slowly build upon that as we move forward. Now, let us first, before even seeing how ECL is actually calculated, let us actually see what are the journal entries that I will post for recognizing ECL. All right, what are the journal entries that I will post when we recognize ECL? All right, now if it is an on-balance sheet exposure, if it is an on-balance sheet exposure, the entry will basically be P&L debit to provision for ECL. Sorry for the beautiful handwriting. All right, just like how it was P&L debit to provision for bad and doubtful debts, same way it is P&L debit to provision for ECL. All right, this is for on balance sheet amortized cost exposures. Let me just make it a little more clear. This is for on balance sheet amortized cost exposures. Just like how we used to create P&L debit to provision for bad and doubtful debts, it's an exact replica of the same. P&L debit to provision for ECL. Obviously, when I say P&L, under P&L, you have multiple heads, right? Like one head is salaries, other head is administrative expenses. Under P&L, you will obviously recognize an expected credit loss expense. All right. Under, just like how you have salaries as one head, admin expenses as another head, you will also have a separate row on the face of the P&L called as ECL expense. All right. So whenever I write the word P&L, think of it as ECL expense debit to provision for ECL, and this is going to be a balance sheet nominal. Okay, the debit is to the P&L and the credit is to the balance sheet account. Now, this provision for ECL is going to be presented as a reduction from our debtors. All right, so if this is your typical balance sheet, you are going to show debtors of, let us say, $100. You will then show ECL as a reduction. You will then show provision for ECL as a reduction, say of $10, and you are going to show a net balance of $90. This is going to be the net dollars. So what I'm trying to emphasize is this provision for ECL, which actually has a credit balance, is going to be shown as a corresponding reduction from the asset. All right, this is a contra asset account. It is not a liability account. It's a contra asset account, which is going to be shown as a reduction from the asset itself. That is for on-balance sheet exposures, which are measured at amortized cost. Now moving on to on-balance sheet exposures, which are measured at FVOCI. All right. Now, under the amortized cost, whether it is debtors or whether it is loans, or whether it is investment in debentures, it's the same approach. For on-balance sheet FVOCI, if you think of it, I would have already recognized the fair value changes. I would have already recognized the fair value changes through other comprehensive income. All right. I would have probably already recognized the fair value changes through other comprehensive income. And what is actually coming on my balance sheet? Let us say I have investment in debentures, which is measured at FVOCI, or investment in debentures or bonds measured at FVOCI. Let us say this is coming as $900. This 900 is already the fair value. And if I have purchased it for $1,000, let us say if I purchased it for $1,000, this loss of $100 has already been recognized in other comprehensive income. The loss has already been recognized in other comprehensive income. You will have accumulated OCI in the shareholders funds, which is basically having a loss of $100. All right, it's going to be already recognized in OCI. And this $100, if you carefully think of it, why has the debenture or the bond price fallen from 1,000 to 900? It probably fell down from 1,000 to 900 because people are believing that the company may not actually honor its obligation. I, as an investor, I am probably believing that the company cannot honor its obligations. Therefore, the price of the bond has actually fallen from 1,000 to $900. So if you actually think of it, the credit loss is nothing but the loss on account of the counterparty not being able to honor its obligation. That loss is already recognized in OCI. I'm just repeating myself. I purchased a debenture at $1,000. After I purchased, 1 year later, the price of debentures has fallen from 1,000 to $900. The question I'm asking you is, what drove the fall from 1,000 to 900? The answer or the response that I'm giving you is, probably investors as a collective unit started believing that the company may not honor its obligation. Because they believe that the company may not honor its obligation, they have basically reduced the price. All right, people started selling the asset off, and the price fell down from 1,000 to 900. All right, the price has fallen from 1,000 to $900. The loss of $100, in my books of accounts, because I'm holding the bond with me, I have already posted an entry, which is OCI debit to investment in debentures. I recognize the loss of $100, which is going to be shown as part of shareholders' funds, and the asset is now valued at $900. What I'm trying to tell you is, this $900 is already after recognizing the credit loss. My cost was 1,000. I have already recognized the credit loss of $100, and therefore I've already shown the asset at its fair value of $900. why am I actually now being forced to recognize provision for ECL over and above that when the balance sheet value of $900 already takes into account the credit loss that I am going to incur? Then why should I again recognize provision for ECL over and above it? All right, because when I discussed the scope, I said it is also applicable to FVOCI instruments, but now I'm actually contradicting myself and I'm telling you that the balance sheet value is already after taking into the credit loss, after taking credit loss into account. So why should I recognize ECL again? Now, before I tell you the answer, I'm telling you the journal entry that we are going to recognize for ECL in case of FVOCI instruments. The entry will be P&L debit, and we are not going to credit provision for ECL. We are going to credit other comprehensive income. So what we are basically doing is we want the ECL to actually be recognized in the P&L account. All right, we want the ECL to be recognized as a loss in the P&L account. That loss is currently sitting in accumulated other comprehensive income. So what I will do is I will actually then recognize an entry of P&L debit $100 to other comprehensive income credit $100. So what has happened is I have actually recognized the ECL in the P&L account and I've credited OCI by $100, and the ultimate position is going to be basically in this format. Investment in bonds will be at $900, and I will have a retained earnings of $100, and accumulated OCI or other comprehensive income will be basically zero. Now your obvious question is, then why the hell have I called this a bond as FVOCI bond and not an FVPL bond? Indirectly, the ultimate impact was that of an FVPL bond, right? Your question should be, why are we categorizing such bonds at FVOCI firstly? Now I'm giving you further information. Let us say cost was $1,000. Fair value is $900. But I am now telling you that this fall of $100 can be attributable to two reasons. One is it can be attributable to market changes. Let us say RBI has increased the interest rate. That is called as a market change. The second could be, it could be attributable to credit risk of the company. If it is attributable to market change, let's say I'm giving you numbers, out of the $100 fall in value, let us say $70 is attributable to market changes, like, general interest rate going up, the GDP of the economy changing, and so on and so forth. What is attributable to the counterparty credit risk is, let us say, $30. The first journal that we are going to actually post is OCI debit of $100 to investment in bond. All right, I originally purchased it for $1,000. Now I'm reducing that by $100 in my books of accounts. All right, I'm reducing that as $100 by $100 in my books of accounts. But out of this 100, $30 is attributable to credit risk. All right, so what we are basically going to do is P&L debit of $30 to other comprehensive income of $30. So what has now happened is the fair value changes which are attributable to market has gone into OCI, whether it's a gain or whether it is a loss. The fair value changes have gone into other comprehensive income, whereas the credit risk, the fair value changes that are attributable to the credit risk is now gone into P&L account. It has now gone into P&L account. So although we are actually saying that ECL is applicable to debt contracts which are measured at FVOCI also, what we are basically trying to say is the balance sheet value is already coming in at the fair value itself. So do not touch the balance sheet value. The only thing that needs to be touched is the P&L and other comprehensive income. We want expected credit loss to be booked as a loss in the P&L account and not as a loss in OCI. If debt instruments were scoped out, if debt instruments at FVOCI were scoped out, what would happen is the entire $100 would have been recognized as a loss in OCI, which is what we wanted to actually avoid. All right. And the final balance sheet, I'm hoping that you guys are able to imagine. I have an asset of $900. I have a retained earnings loss of $30, and I have an OCI loss of $70. That is how we're actually going to have our final balance sheet presentation. So debt contracts measured at FVOCI, it is actually, ECL is actually applicable, but we are not going to touch the value at which our asset is being disclosed. Rather, we are just going to do a switch from OCI into P&L account. Alternatively, you can obviously merge these two entries. You can merge these two entries and directly recognize one entry, which is OCI debit of $70, P&L debit of $30, to investment in bond of $100. That will directly suffice your ultimate requirement. So these are the journal entries that we are going to recognize for on-balance sheet exposures measured at amortized cost and measured at FVOCI. We can also have off-balance sheet exposures. Remember, we can also have off-balance sheet exposures. Example that I gave was loan commitments and financial guarantees and so on. FG is called as financial guarantees. And then we can also have loan commitments. The entry is basically the same, which is P&L debit to provision for ECL. The entry is the same as that of on-balance sheet exposures, which are measured at amortized cost. Only difference is you do not have an asset, all right? You do not have an asset in case of off-balance sheet. In case of on-balance sheet exposures, you had loan amount, you reduced ECL from the loan amount. Over here, you do not have the loan amount itself. You have directly recognized provision for ECL. So what are you going to do? This is going to be shown as a liability. If you are recognizing any ECL with respect to off-balance sheet exposures, you are going to recognize it as a liability. It is not a contra asset account. Whereas if it is against an on-balance sheet exposure, it is going to be a contra asset account. In case of on-balance sheet FVOCI, there is no provision for ECL on the balance sheet side at all. There is no provision for ECL in case of on-balance sheet FVOCI. Okay, if you just, in case you're by chance confused, I'm just summarizing it once again. On balance sheet amortized cost, we are going to have provision for ECL as a reduction from our debtors account or our loan account. On balance sheet FVOCI, we do not have provision for ECL at all. We do not have provision for ECL on the balance sheet at all. Directly, we're showing our investment in bonds at $900. In case of off-balance sheet ECL, this ECL is going to be a liability account. It will be shown on the balance sheet liability side because you do not have an asset at all in the first place. You have only entered into the contract today. You will have an asset at a later point in time. If you disburse the loan in future, you will have an asset. But today, it isn't. This provision for ECL is going to be a liability account. All right. So on off-balance sheet, it's going to be a the provision for ECL is going to be a liability account. That is how you would recognize journal entries for ECL, which are measured at amortized cost and FVOCI and off-balance sheet exposures. There are two broad-based approach that the accounting standard IFRS 9 actually permits. One is called as the general approach. The other is called as the simplified approach. Two approaches, general and simplified. There's a third category called as purchased or originated credit impaired, POCI, purchased or originated credit impaired asset, which I will come to at a later point in time. For now, you can think that we just have two approaches, which is general and simplified. General approach, in fact, I've actually not given you the actual definition of ECL, which is there in the text. I will bring that definition at a later point in time. But what I want to actually first emphasize is what people in the industry usually do. General approach, it applies one of the most commonly used formula for calculation of credit loss. It calculates credit loss as exposure multiplied by PD multiplied by LGD. All right. This is one of the most common formulae that is applied across the industry. Exposure multiplied by PD multiplied by LGD. What does PD mean? It means probability of default. LGD stands for loss given default. All right. PD stands for probability of default. LGD stands for loss given default. And exposure is often referred to as EAD, which is exposure at default. All right. So EAD multiplied by PD multiplied by LGD. Exposure at default multiplied by probability of default multiplied by loss given default. That is the general approach. The second approach, which is simplified approach, is nothing that what you would have probably done at basics level, where you calculate an aging based provision. If the debtor is due from 0 to 30 days, I will recognize a provision of 1%. If the debtor is due from 30 to 90 days, 10%, greater than 90 days, 50%. What you basically used to do in your lower levels, that is actually nothing but the simplified approach. All right, we're going to discuss both of them in further detail now. All right, so let's take an example to see how ECL is actually calculated. I have taken an example where I've presumed myself to be a bank and I have given a loan to Mr. X of say $100 million at carrying an interest rate of 10%. All right, I am a bank. You are, let's say, Mr. X, who has come to me and has asked me for a loan, and I have given you a loan of $100 million at the rate of 10%. The tenure that we are agreeing to is say 5 years. All right, we are agreeing to a tenure of say 5 years, which means over a period of 5 years, you will pay me interest. At the end of 5th year, you will repay the $100 million loan to me. All right, I've assumed a bullet payment. Alternatively, you can have different forms of payment, like payment being made equally every year and so on and so forth. So five years, $100 million, a bullet payment at the end of 5th year, loan being the interest being charged at a rate of 10%. The additional information that I am giving to you is, let us say the probability of default is 7%. Now, what does PD mean? Probability of default is nothing but I, as a bank, I am estimating today what is the probability that Mr. X will actually default. All right, I am estimating today as to what the probability is that Mr. X is going to default. I have estimated today that the probability of default is 7%. This I have estimated right on day one. All right, I have estimated this right on day one. Obviously, every bank, I'm coming out of this discussion for a minute, every bank, obviously, when it is giving a loan, it is not 100% certain that the loan will be repaid. A bank always knows that there is a chance that the loan may actually not be repaid back. All right, please come out of this notion that if the bank already knows that there is a chance of default, then why is the bank even giving a loan? That is not the right way of thinking. Every bank, whenever it is giving a loan, it knows that there is a chance of default. They just try to minimize that chance as much as possible. Or what they do is they increase the interest rate that is actually being charged. All right. For example, if you go to a bank asking for a personal loan, the interest rate is going to be higher compared to that of a house loan, because they know that in case of a house loan, you have the property as a collateral. They will see your last few months salary slips. They know they do enough background check. Whereas in case of personal loan, more often than not, it is uncollateralized. All right. So they increase the interest rate because they know that the chance of default is slightly higher on that front. All right. So please come out of this notion that on day one, the probability of default is supposed to be 0. No, it is not going to be 0. There is going to be a chance of default that actually happens. But what banks basically do is they are going to give hundreds of such loans. All right. They're going to basically give hundreds of such loans. And when you're diversifying your loan base, obviously a probability of default keeps shrinking, right? As you keep diversifying, your risk reduces. That's the basic portfolio management, right? Similarly, banks also, they try to diversify their loan portfolio so that the probability of default across the loan portfolio is slightly on the lower side. All right. Obviously, I've taken only one loan over here for the sake of convenience. Coming back to our discussion, on day one, the probability of default is 7%. That is, there is a chance that the chance of Mr. X defaulting over the term of the loan is say 7%. Over the life of the loan, the probability is 7%. This probability of default is a function of two main attributes. One is credit quality of the borrower. The second is the tenure of the loan. It's a function of two things primarily. One, the credit quality of the borrower, The second is the tenure of loan. For example, based on the credit quality, what do we mean by credit quality? This encompasses the financial strength of the company, the financial strength of the borrower, what kind of collateral is he giving, and so on and so forth. The credit quality of the borrower is how good is the borrower. All right, this is often proxied using a credit rating. All right, credit quality can be proxied using a credit rating. But by credit quality, what we are basically trying to understand is what is the financial position of the company, of the borrower. I mean, how much debt does he already have on the balance sheet? What are his ratios? What is the debt equity ratio, current ratio, so on and so forth. So credit quality is trying to actually see the how good the borrower is. The second the second attribute which is going to drive probability of default is the tenure of the loan. Longer the tenure of the loan, greater the probability of default. All right, if I am giving you a loan of 10 years, then obviously the probability or the chance of you defaulting over the next 10 years is going to be much higher, as against, let us say I'm giving you a loan of 1 month. In the next 1 month, the chance of you defaulting is obviously going to be on the lower side. So PD is a function of two things: credit quality, which can be proxied using credit ratings, because credit ratings are nothing but how good the borrower is. Credit quality also is the same thing, which is how good the borrower is. The second thing which drives PD is the tenure of the loan. Now, obviously, better credit quality means lower PD. Lower tenure means lower probability of default again. All right. So lower PD is going to arise from a better credit quality and a lower tenure. If the credit quality is poor or if the tenure is too long, then probability of default is going to be higher. Another thing that I want to clarify is this is the probability of default on day one. As time progresses, this 7% will also keep changing. Today, the probability of default is 7%. 1 year later, 2 years later, let us say the economic circumstances change. The entity is, the companies, the Mr. X who's carrying out a business, let us say his business actually starts failing. The demand for his product falls. There are some poor economic conditions. The demand falls and basically he's bleeding in losses. The probability of default is going to shoot up. All right, let us say he's actually doing very well for himself. The probability of default may actually come down. All right, so this probability of default of 7% is not going to remain constant. It is going to actually change with time. And one more thing that I want to emphasize on is, as your tenure reduces, initially the tenure was 5 years. As your tenure keeps going down, because obviously passage of time is an inevitable thing, right? As the tenure keeps going down, obviously the probability of default again starts falling, even everything else remaining constant. Even let us say if the credit quality of Mr. X has not changed, still the probability of default will keep going down as the tenure reduces. All right, because today you're standing at 5 years. Later you'll stand at say 4 years, then 3 years, then 2 years, and then 1 year, and your probability of default will slowly keep coming down and down. All right, so PD is not a constant number. It's going to keep changing on each particular reporting date. It can change either because of the credit quality or it can change because of tenure. Or I shouldn't say it can change because of tenure. It will change because of tenure, because tenure passing down is a inevitable event. All right, that is definitely going to happen. All right, so the PD is certainly going to reduce on account of tenure reduction. What we do not know today is how the credit quality is going to shape up in the years to come. All right, so PD of 7% is as at day one. It might keep changing at each reporting date. Next is the loss given default. Let us say is 30%. What do we mean by loss given default? Loss given default is if the default occurs, given that default has occurred, what is the amount of loss that you're expected to incur? All right, just because I've given you a loan of $100 million, does it mean that I'm going to lose the entire 100 million? The answer is no. I will obviously recover some money from you, right? The loss that I will be incurring is 30%. All right, given that default has occurred, presuming that default has occurred, what is the loss that I will incur? That is called as 30. That over here I've taken as 30%, which is referred to as loss given default. The recovery rate is said to be 70%. Although the term recovery rate is not explicitly used in IFRS, I am just telling you that recovery rate is going to be 70% because I'm going to recover 70% from you. So on day one, I will be actually calculating the ECL as exposure at default multiplied by the probability of default multiplied by loss given default, which is equal to $100 million multiplied by 7%. 100 million is my exposure. There is a 7% chance that you may actually default. And if you default, I'm going to incur a loss of 30%. I've written it as 0.3. So there I have got an exposure of $100 million. Probability of default or the chance of you defaulting is 7. And if you default, I'm going to incur a loss of 30%. Therefore, my answer, I guess, will be around $2.1 million. All right. So when I'm giving you a loan of $100 million on day one, I am going to recognize an ECL of $2.1 million. I give you a loan showing, which means I'm going to have an on-balance sheet exposure of $100 million, a loan of $100 million. And on day one itself, I will be recognizing a corresponding ECL of $2.1 million. And I will show that 2.1 as an expense in the P&L account, and it will be a corresponding reduction on the balance sheet. All right. So the net balance sheet exposure will be 100 minus 2.1, which is $97.9 million. That is how I calculate ECL. So ECL is calculated as EAD multiplied by PD multiplied by LGD. All right. So if you actually see 100 multiplied by 0.3, if I just circle these two, 100 multiplied by 0.3 is the loss that I'm expected to incur. All right. This is the loss that I'm expected to incur if the default happens. But what is the chance of default happening? It's only 7%. So out of the $30 million, the chance that the default is going to happen is only 7%. And therefore, I'm going to recognize a loss of only $2.1 million. So there is a chance of 93% that default will not occur. All right, there's a chance of 93% that default will not occur. Now, like I mentioned earlier, these probability of default and even loss given default, both probability and loss given default, they are not constant. They will keep changing as time passes by. So is your ECL number going to remain constant? The answer is obviously no, right? Over here, your exposure will be $100 million only because I've assumed that the principal is going to be repaid at the end of the 5th year. But if you have a principal repayment in between, your exposure will also change. So as your exposure, PD and LGD keep changing, your ECL will also keep changing. Let us say this is on day one. On the balance sheet date, if you have an ECL of 2.5 million, then you will recognize that incremental 0.4 million to P&L account. You already have a provision for ECL of 2.1 million on which you recognized on day one. If you, let us say, have an ECL provision on a balance sheet date of 2.5 million, applying the same formula, let us say you get 2.5 million on balance sheet date, then you increase your provision for ECL by 0.4 million, and that 0.4 million will again be a P&L debit. The entry will be P&L debit of 0.4 to provision for ECL of 0.4 million, and your cumulative ECL will become 2.1 plus 0.4, which is equal to 2.5. How will you show that in your balance sheet? You will have loan $100 million minus provision for ECL $2.5 million, net amount $97.5 million. I'm just writing it down quickly. This is, let us say, on day one. Okay, let us say 1 year passes by, balance sheet date. I am again calculating ECL using the same formula, but your inputs have actually changed this time. Either your PD has changed or your LGD has changed, and I have an ECL of 2.5 million. This incremental ECL of 0.4 million will be again P&L debit to provision for ECL. You already had a provision for ECL of 2.1. After you recognize this journal, you will have an additional provision for ECL of 0.4, thereby cumulative provision for ECL will become $2.5 million. And this will be shown as a reduction from asset. If this happens to become 1.8, then you will have a reversal of ECL. if let us say on balance sheet date, ECL is 1.8 million, you will have a reversal of 0.3 million, and that will be a P&L credit. All right. So any changes to ECL from day one until the balance sheet date will be recognized as P&L gain or P&L loss. Any change in ECL from day one up to the balance sheet date will be recognized as a gain or as a loss in the P&L account, and the corresponding will be obviously the provision for ECL. That's it for this lecture. We are still not done with the concept of ECL. We have still a lot more to discuss, but I will end the lecture over here and we'll continue in the next session. Thank you everyone for joining. Bye-bye.